Are you sitting awake at night, looking at your retirement accounts, wondering if the money you spent 40 years saving could just vanish into thin air if a major bank goes under? It is a terrifying thought. You see the headlines about economic instability, you remember the bank failures of the past, and you look at your 401k or your IRA and you think, if that institution locks its doors tomorrow, what happens to my money? Am I going to be left holding an empty bag when I am supposed to be enjoying my golden years? I want you to take a deep breath. Stop agonizing, because today we are going to strip away the fear and look at the absolute facts. We are going to talk about the two massive safety nets that protect your money, the FDIC and the SIPC. You need to understand exactly how they work, where they overlap, and most importantly, where the holes are, so you can make sure your hard-earned wealth is completely bulletproof. The SIPC provides up to $500,000 of total protection per customer, per separate account capacity. And within that $500,000 total limit, up to $250,000 can be used to cover cash that was sitting in the account waiting to be invested. Just like the FDIC, those limits apply to separate capacities. Your traditional IRA is one capacity. Your Roth IRA is a separate capacity. An individual taxable brokerage account is another separate capacity. So if you have a traditional IRA with $400,000 in mutual funds and a Roth IRA with $300,000 in stocks at the same failed broker, both are fully protected up to their individual $500,000 limits because they are held in different capacities. Now, listen to me closely, because this is the absolute most important distinction you must understand, and it is where people trip up every single day. SIPC insurance does not protect you against market loss. Let me say that again. If you own a mutual fund in your IRA, and the stock market crashes, and your account value drops from $400,000 down to $250,000, the SIPC will not give you a single dime. That is market risk. You chose to take that risk when you invested in the market. SIPC only protects you against the financial failure of the brokerage firm itself, ensuring that the physical shares you bought are safe or replaced if they go missing. It is a shield against theft and bankruptcy, not a shield against a bear market. So, what about your 401k? If you are still working, or if you left your money in your former employer's 401k plan, how is that protected? A 401k plan is typically held in a trust, separate from your employer's business assets. If the company you work for goes bankrupt, their creditors cannot touch your 401k money. The assets are held by a custodian, usually a major financial institution. If that custodian institution itself fails, then the rules we just discussed apply depending on how the funds are held, and the plan administrators work to move the trust assets to a new custodian. Furthermore, employer-sponsored plans are heavily regulated under a federal law called ERISA, the Employee Retirement Income Security Act, which requires strict fiduciary duties to keep those retirement pools insulated from corporate financial distress. But what if your retirement nest egg is much larger than these limits? What if you have worked your entire life, lived below your means, and you have $1 million or $2 million sitting in a single retirement account? Are you just exposed to the wind if something catastrophic happens? Not necessarily. First, many of the major brokerage firms carry what is called excess SIPC insurance. This is private insurance policy coverage that companies purchase out of their own pockets to protect their clients. It kicks in only if the standard $500,000 SIPC limit is exhausted. For instance, firms like Charles Schwab or Fidelity carry aggregate excess policies worth hundreds of millions, or even $1 billion, to ensure that even ultra-high net worth investors are protected if assets go missing during a firm collapse. You need to call your brokerage firm and ask them directly, do you carry excess SIPC insurance, and what are the individual limits? Second, you have to look out for the cash sweep programs. When you have money sitting in a brokerage retirement account that isn't currently invested in stocks or bonds, the broker sweeps that cash into an interest-bearing account. Many modern brokerages use a multi-bank sweep program. They automatically take your uninvested cash and spread it across a network of 5, 10, or 15 different partner banks in chunks of $250,000 or less. By doing this, they can provide you with $1 million, $2 million, or even $5 million of total FDIC insurance on your cash, all managed under your single brokerage login. So, what is your actionable takeaway right now? How do you take control of this situation so you can sleep like a baby tonight? First, I want you to log into every single one of your financial portals and print out your latest statements. Look at where your money is physically held. Second, identify the type of institution. Is it a bank, or is it a brokerage? If it is a bank, verify that they are an FDIC member. If it is a brokerage, verify they are a SIPC member. You can do this easily on the FDIC and SIPC websites using their institutional lookup tools. Third, do the math. Look at your total cash balances at each bank. If you have a single checking and a single savings account at one bank under your name alone, and the combined total is over $250,000, you are exposed. Move the excess money immediately. You can move it to a different insured bank. You can open a joint account with your spouse to get an additional $250,000 of coverage, or you can utilize an automated bank network service that spreads the deposits for you. Fourth, look at your brokerage accounts. Check your uninvested cash balances. Ensure that your cash sweeps are directed into FDIC-insured partner banks or high-quality money market mutual funds, which are treated as securities and protected under the $500,000 SIPC limit. Your retirement security is entirely in your hands. The system has incredibly strong, proven guardrails designed specifically to protect people just like you, people who worked hard, saved responsibly, and want to ensure their future is secure. Do not let vague fears keep you up at night. Check your balances, verify your institution's insurance status, align your assets within the legal limits, and then sit back and enjoy the retirement you earned. You can do this.